I'll record this and I'll put it up so you can look at it later if you need to. Okay, but let's go ahead and let's take a look at this test. Okay, and we've got this Mojo Coffee House that notices that its contribution margin is shrinking, and it wants to try to figure out what's going on with this. And so they start to analyze the direct materials used in its operation. They tell us some information about what they purchased, etc. And they want us to determine the following for the materials. Okay. And they want both price and they also want quantity. So this is one of those problems where you got to work doubly hard to get the points, right? Because you got to get two of the ratios for this one. So if we're going to do price, just looking at our formula, price is going to be what? Actual quantity purchased. And so we look down here and they tell us that they purchased how much? 30,000 pounds of coffee. So we take the 30,000 and then we're going to multiply that by the standard price minus the actual price. Now they tell us that the standard cost here is what? 310, isn't it? So I grab that 310. But usually in these problems they're going to make me work a little bit to get the actual price. So they tell me that they purchased 30,000 pounds of coffee for $112,500. So I should be able to take that 112,500, divide that by what? Divide that by the 30,000 pounds of coffee, and that's going to give me an actual price there of what? Come on, guys, don't leave me hanging up here with having to do everything by myself. What is it, 375? Okay, so it's 375 per unit. So I take the what? I take the 30,000 times that what? And it's going to be a negative 65.65. Negative 65 cents. Okay, and that gives me what? Negative 19,500. Now this problem was kind of a trip in that they didn't call them out as favorable, unfavorable, but they did show them as negatives, didn't they? Okay, so I know the answer is B because I've highlighted, but it's either got to be, well, I know it's not D at this point, but I'm going to have to sit here now and figure out the quantity usage variance. So quantity usage, quantity, whatever. Okay, it's synonymous terms. I've got to pick up what? Standard price is 310, and I'm supposed to take what? I'm supposed to take the standard quantity minus the actual quantity. This problem was a little better in that what? They went ahead and they gave me the actual quantity was 28,000. And this one, unlike some others, they didn't make me calculate the standard quantity. They just gave it to me, didn't they? Okay. Whoops, I got this backwards. Standard quantity was how much? Standard quantity here was supposed to be, they purchased 28,000 coffees. However, 28,000 pounds of coffee were used. The what? 26,000 pounds should have been used. So that's the standard, isn't it? Okay, so 26,000 minus what they actually used, which was what? 28,000. So that's 310 times what? A negative 2,000. What that gives me, this negative 6,200. Okay. All right. So pretty much what we've been practicing. I think some of the earlier questions we saw, they were sort of more table format. I think that you can plan on questions that are going to get away from the table approach while we were starting to get our feet wet on this and now starting to move more into this paragraph type format, right, where you're having to read through and pick out the numbers you need as opposed to the table just sort of laying them all there for you. Okay? Okay, good. Let's go ahead then and let's take a look at this one. And now we've got the overhead efficiency variance. Overhead efficiency variance, you can see, and again, you'll have this on the top of your page here. I'll just put it on the first page because I don't want to turn the test into a 90-page test to print it on every page. But you'll have to turn back to the first page. But we have what? Efficiency variance for our overhead is the standard rate times what? Standard hours minus actual hours, right? So you come over and thank you, sir. Everyone sign this already? Okay, thank you. And so we have what? Budgeted is standard, actual is what? Actual. So my standard rate here for my overhead is what? Standard rate is what? Huh? The budgeted rate, which is good, $2. Thank you. Everyone sign this? Can you actually hand it back? I don't think it made it through this. Thank you. Okay. So it's $2. And then what? Then it's going to be the standard hours minus the actual hours, right? So the actual hours are, did they go ahead and tell me that it's 2100? Is the actual hours? Okay, so now I just need to get the standard hours, and it's 0.9 per frame, 0.1, excuse me, per frame. So how am I going to compute that? Huh? Think, guys. Turn on the brain here. Click on the brain. Just don't go over the edge of the mountain here. What? Say it again. 0.1 times the actual number of frames, right? Huh? That's how long it should have taken me to make up these frames, right? Okay. And so what's that, 1900? Okay. So 1900 minus 2100, what's that, 200? So $2 times a negative 200 going to give me negative 400? Right? Okay. Everybody sign that thing now? This is to be causing a dilemma here. I'll go ahead and take it. Thank you, sir. Question on this one? Sir? You okay? Okay. Anyone else? Okay, good. All right, so let's go ahead and let's take a look at this one now. And we are going to get the direct labor efficiency variance. Direct labor efficiency variance is going to be what? Standard rate times standard hours minus, standard hours, John, is what we want to write here. Standard hours minus actual hours? Okay, good. So the standard rate is, what is it, $15 per hour? Okay, so $15 per hour. And then my standard hours minus my actual hours. Actual hours is what? 3,000 actual hours. Good. Standard is what? Supposed to take me a half hour per widget. And I produced how many widgets? 10,000 widgets. So I take this 0.5 times the 10,000. What's that? 5,000? Man, we must have a manager that was cracking the whip here, right? I don't know how we got that many hours underneath, but very productive, very efficient, right? I don't know how we got that many fewer hours. If I saw something like this, I'd think there was something wrong with our budget to begin with, and we need to change our budget in the future, right? And we shouldn't be that far under the amount of hours, right? But I guess it happens sometimes. That's 30,000 favorable. Very favorable. Okay. Okay, good. Let's go ahead and let's take a look at this one. And now we want our price variance for what? For our materials, I guess. Be nice if they would tell us what we're looking for here. I guess it's materials. Okay. Yeah. Be nice if they made it more clear what we're looking for here. So if it's the price variance for our materials, it's going to be what? It's going to be actual quantity purchased, right? I'll put a little P down there for purchase. And it's going to be standard price minus actual price. Okay, good. And so my actual quantity purchased is going to be what? What do they want here? To meet its monthly budgeted goals, planned a need of 10,000 widgets, a price of $20 per unit. Actual units were 11,200 at a price of 1850 per widget. I don't know what they want. I'm guessing it's the materials. This is kind of a poorly written question. But so what's my actual quantity? 11,200. And then the what? Standard price here is what? Is $20. And the actual price, and I don't have to do any calculations here. Sometimes they give me the total they spent, but they tell me how much the actual was per widget here, don't they? Okay, there are some problems where they just give you the actual price per widget, and to use the formula the way I've described to you here, you just grab that number, right? This actually is a little easier than the other ones where we had to do another calculation. But 11,200 times, what's that, $1.50? Should give me this, what, 16,800 favorable? Okay. Okay, good. Let's take a look at this Water Control Inc. And we're looking for direct labor price variance first. Same thing as rate variance. So it's going to be what? It's going to be the actual hours times the standard rate minus what? Minus the actual rate, right? Okay, so I start to look here. Do they tell me the actual hours? So they're giving me that. Do they tell me the standard rate for labor here? $9. Can I figure out the actual rate? How? Good. 940,000 is what they paid, and that's divided by what? 94,000 hours. So that's 10 bucks, right? Even I can do that one in my head. So that gives me 94,000 times -1. So it's a negative 94,000. That means it's unfavorable, right? Okay, good. Notice, guys, that some of these problems cloak themselves in, complication. I mean, you look at this and you're thinking, I mean, when I first start working these questions, when I'm, reviewing prior to the class, some of these I look at and go, oh, why did I assign this problem? This is going to be like really hard problem. And then I look at it and I remember, oh, yeah, that's right. Half the numbers were just given to you right there, weren't they, in a couple of lines of this? So when you see a question like this, you got to control the emotions sometimes on these, right? Their answers, you stay calm by knowing that you have the formula, and then you just got to sit there and figure out how to grab the numbers out of the formula, right? Okay, or out of the, not out of the formula, but out of the problem to stick them into the formula. Okay, good. How about then, with that in mind, how about this one? Okay, so you look at a problem like this and you start thinking, okay, this is going to ruin my Thanksgiving. Okay, so what do you do with this one? Well, they're giving me information, what? Per unit, aren't they? Okay, so for the way we work these questions, that's good news for us because we don't really have to turn things into per unit amounts here now, do we? Right? Because they're pretty much giving it to us. Okay, which is we do these on a per unit basis, and then what? Then they sit there and they give me the what? The standard. So here's my standards up here. And then down here they give me what? The actual. So when you think about it, even though this looks kind of complicated, this is almost a table version of what we've done in the past, right? Okay, where they're just giving me the numbers. So they asked me my materials quantity variance. Materials quantity variance is going to be what? The standard price times what? Standard quantity minus the actual quantity, right? So do they give me the standard price for this for these materials here? Standard price is supposed to be $1.50 per pound, isn't it? Right? Got to look up there for the standard, $1.50 per pound. Okay, and then it's standard quantity minus actual quantity. Now, to get actual quantity, since they're sitting there and they tell me that what? They use 58 pounds at $1.65 per pound. This one's a little bit backwards in that they're giving me the per unit. Usually they give me the total and I got to turn it into a per unit. Here they've done what? They've gone ahead and given me the total. And so the total here is this, what, 16, how many units did they produce? 1650 units. And they used how many pounds per? They used 58 pounds per. Okay, so the actual quantity that they used here is 95,700, isn't it? They produced 1650 units. They used 58 pounds a pop. And if I produce 1650 units, they tell me up there that I was supposed to use what? 60 pounds per unit, wasn't I? That was the standard. the 60. Remember standards up there? So 1650 times the 60 pounds per unit means that I should have used 99,000 pounds, right? Am I doing my math right? So $1.50, and then we have what? 99,000 times 95,700 is 3,300. So $1.50 times 3,300, does that give me this 4,950 favorable? Okay. Okay, good. Using same facts as question 6, can I get the materials price variance now? Okay, so I got the quantity. I want the price variance. It's going to be what? Actual quantity times standard price minus the actual price. So the actual quantity, and its actual quantity what? Used or purchased now? Purchased. So of course we're in luck because they tell me what? Materials purchased and used. Okay, so they used what? The 58 pounds times the 1650 units. Same number, 95,700. Everybody see where that number is coming from? Okay, and then standard price, and if we look at the standard price they told me up there was what? $1.50 per pound. We'd already found that number earlier. Okay, $1.50 per pound versus what did they actually pay? 165. So that gives me what? This 14,355, and the number is going to be negative, so it's unfavorable. Right? Okay. Same facts. What is the labor rate variance? Labor rate variance is going to be the what? The actual hours times the standard rate minus the actual rate. Now you look over here and you look to the actual section here, the actual listing of information here, and they tell me that their labor was what? 3.1 hours, and remember this is per unit. So if I take the 3.1 times how many units? 1650? 1650 the actual number of units? Okay, so that gives me actual hours here that got used at what? 5,115? And then I sit there and I look at my standard rate, and my standard rate is coming up to my standard area is what? 12 bucks? Let's switch over to red since this is starting to get a little traffic here. $12. Okay. Meanwhile, my actual was $12. Okay. So we can see that the answer is going to be 0 here pretty quickly, pretty easily, right? 12 minus 12 is 0. Okay. You know, I think a labor rate variance of 0 is probably fairly common. I mean, it's not like we get halfway through the accounting period and all of a sudden, you know, people get a raise that we didn't expect or something like that. So, you know, I think a 0 labor rate variance is probably not that unusual. Huh? again, what do we say to the Galveston? Hey, we were going to pay you 12, but you'll take 9, right? Who are we, Trump? So I think it gets a little bit weird to all of a sudden see the rate change in the middle of the accounting period. The only thing I can think of is if we were going out and getting contract labor, and we might start to say, well, what's wrong with our negotiating skills that all of a sudden, we're having to pay a different labor rate. But assuming we're, bringing employees on in the usual manner, I would think that your rate variance should be pretty close to 0. So, okay. I think to me, the one that we're more interested in for labor is the usage, the efficiency variance, right? Because if we're sitting there and we're incurring all kinds of extra hours, overtime, well, that might be something with the rate. If that when we get into overtime, we got to pay them time and a half, that might be explaining why all of a sudden, well, we got this rate variance because originally we didn't anticipate having to pay overtime. Now we are, right? So that could actually drive the rate variance too. If the amount per hour went up for overtime. Okay, good. How about this one? What are we looking for? We're looking for the price variance here. Okay. And I like this one. The controller for Durham Skates is reviewing the production cost. And we have an unfavorable flexible budget variance of $25. So we're pretty close to what? To 0 here on our variance, aren't we? Okay. And so what happens? The plant manager believes this is excellent performance on a flexible budget of 5,000 units of direct material. So he's saying, hey, for 5,000 units, that's pretty good that we used up this material. However, the production supervisor is not pleased with the result, as he claims they have saved $1,200 on material costs on the actual production budget of 4,900 units. So I don't know what this plant manager is thinking, that he's saying, oh, okay, we did good if our budget was what? If our budget was 5,000 units. Meanwhile, we only produced what? 4,900 units, right? Okay, so we have to sit there, and if we want the price variance, should we use the budgeted or should we use the actual? Got to use the actual, don't we, for the price variance? Okay, so I don't know. That guy should have, kept quiet. It shouldn't have started saying, oh, that's pretty good if we have an annual budget of 55,000. Meanwhile, we didn't produce that many units, right? Okay, so we've got this what? We've got this 4,900 units, and they tell us that we are supposed to do what? We're supposed to pay $12 for our material cost, aren't we? Is that our standard? Standard price is $12. Meanwhile, we did what? We paid 60,000, 0.25, and we needed to divide that by how many units? 4,900. So our actual price for this stuff was $12.25, right? Okay, so 4,900 times a negative 0.25 means that when you look at the price situation, we're actually unfavorable to the tune of what, 1,225? So I think that the production manager is right in that what, if our overall variance is only $25, but our price variance is what, 1,225. If we sat there and figured out the quantity variance, it probably would be favorable, wouldn't it? Okay. Okay, so that allows us to get more to the root causes of our overall variances. That's why I didn't spend a whole lot of time on those overall variances, and we spend more time worrying about the individual price versus quantity, etc. Okay? Question on any of those? Okay, good. Let's go ahead then and let's take a look at some of these budget type ones, okay, from chapter whatever. Okay. Everybody sign in? Anybody not sign in? Kush just hand it back. Okay, so what's happening? They want to see what our cash collections for December should be, right? And they tell us that 25% of the company's sales are for cash, 75% are on account. Collections for cash on accounts follow a stable pattern of 50% of the month's credit sales are collected in the month of sale, 30% in the month following the sale, and what? 15% are collected in the second month following the sale, and they want us to figure out December, right? Okay, so to do this, we have to take this 130,000. Let's just do December. How much did they sell in December? 130,000. But then they tell us that what? 25% of that is cash up front, isn't it? 25% of that is cash up front. So we take that 120,000 times 0.25. We're going to get that in December, aren't we? They say only 75% is credit, 25% is cash. So we're going to get that amount of cash, right, off those December sales. So 130,000 times 25% is 32,500, right? Okay, good. Then what? Then they tell us that of the December sales, which are 130,000, I should say, that 75% of that is on credit, isn't it? 75% of that's on credit? Okay, so let me go ahead and move this 32,500 over. What was this number, 32,500? That number I just erased? Okay. So 130,000 times 0.75 is going to give us 97,500. That's our credit sales, and they tell us that we collect how much in the month of sale? In the month of sale, we get 50% of that, don't we? So we've got 97,500 times 50% is going to give me 48,750. Okay, good. Okay, so we're going to get that in December, aren't we? Right? Then we got to take the what? Then we got to see what we're going to collect for November in December. So we had November sales of 170. And of the November sales in 170, only 75% are credit sales, right? Okay, so 170,000 times 0.75 gives us, what's that, 127,500? And that's for November, and in December we'll collect how much of that? We get 30% in the month after the sale, don't we? So 127,500 times 0.3 gives me what? 38,250? Good. And then I'm going to collect some of the October sales, right? 2 months after October is December. November, December, the 2 months after the sale, right? So I'll get some of those October sales in December, 150,000. I'll get some of the cash on that. Remember, only 0.75 is on credit. So my total credit sales is what? 100 and 12,500. 50% I would have gotten in October. 30% I would have gotten in November. But we're figuring out what? December's cash collection here. And they tell me that I get what? 15% in the 2 months after the sale, don't I? And so that comes to 16,875. Hello? And so I total that up, and I believe that gives me this 136,375, I hope. Right? Okay. Notice, guys, I mean, there's very little accounting going on here. I mean, this is simply a reading comprehension. Can you follow the fact pattern through to see what's supposed to be coming in, right? Question? Okay. Okay, good. Let's take a look at this next one, and they want to know what the budgeted sales are for the company. I mean, they don't want to know what the budgeted sales are. They want to know what are the cash receipts for April, and they tell me that and one of the hardest problems I have with these problems is when they write a number out instead of giving me the percent, because I'm sitting there and I look for the percentage. What's the percent that they collect in April? And I'm looking for a number, and then they, actual Arabic number, and they give me what? They give me a written number, 60%. So they tell me 60% of the credit sales are collected what? In the month of sale. And so since they're asking me April, that means that I should be able to take the April sales of what? 700,000? How much should I collect to that in April? 0.60, so I should be getting what? 420,000 in April. And then they tell me that what? 25% in the month following the sale. So April follows what? March. So I pick up the March. March is 500,000, and I'm supposed to get how much of that? 25% in April. So 500,000 times 0.25 gives me 125,000. And what, am I going to get any of this February? 10% in the second month following the sale. So April is the second month following February. So if I have February sales of 600,000, and I'm supposed to pick up 10% of that, right? So what's that, 60,000? So when I add those numbers up, do I get this 605,000 over here? Okay. Okay, good. Not too tough. Yeah, I guess there is a blank page in there now, isn't there? If I knew how to get rid of them, I would. Okay, so let's go ahead and let's take a look at this one. And we want to know our production budget now. Notice we go from sales to production budget, just like we talked about when we went through the slides, right? That's how these problems are laying out. So they tell us that we're looking for February, and they tell us that they're going to want to sell 360,000 units in February. And so if they tell me that they want to sell 360, the way I do these is I just sit there and I say, okay, if I want to sell 360, then I'm going to start out saying I need 360. Now I know that they probably had some in beginning inventory, etc., but we're going to adjust for that. Okay. Then what? Then they tell me that they had a desired ending inventory of how many? 38,000 units. So I go ahead and I add that in, and so now I have my what? My total needs of 360,000 plus 38,000 gives me, what's that come to for total needs? 398. Okay, good. But I started the month off with what? 36. That was January's ending. Is March? February's beginning, right? So the beginning inventory for February is March's ending inventory of 36,000. So 98,000 minus 36,000 gives me this, what, 362,000? Okay, great. Okay, let's take a look at this one. Now this one was similar to another problem we worked, but I think in the other one that we worked, they only wanted 1 pound of material per item, whereas this wants what? 2 pounds of material per item. But the way I work these is I save that multiplication to turn the units into whatever it is, pounds or whatever they're asking. I do that last, so I don't have to sit there and keep multiplying by 2 the whole time to get the numbers that I need for this. So I just go ahead and I start out with what I want to produce. What month are they asking me for? For May. So I look at May and I say, okay, if I need to produce 19,000 units in May, then I'm going to start with 19,000. Then what? Then they want to have an ending inventory of 20% of the following month's needs. So they're saying I have a production budget of 16,000 units in June, but I only want 20,000 of that, right? So 16,000 times 0.2 means that I want to have an ending inventory of 3,200 units. Okay. Then what? Then they tell me that, well, I would have started, that's my, let me just do my subtotal here. That's my total needs. Total needs is, what's that, 22,200? Okay, good. And then I sit there and I would have started the month with what? Of May with 20% of what I needed for the month. And this is a common mistake, guys. Be careful. Don't pick up that 18,000. That's not what I started this month with. I start my month with what I need for this month, right? Not what I needed to start next month. So 19,000 times what? 0.2 is going to give me 3,800 that I would have started the month with. I subtract that, and that means that I'm going to have to produce 18,400 units. How many pounds do I need per? 2. So I take that 18,400 times 2, and that should give me now this 36,800 pounds. Now this was a generous problem in that what? It didn't give me any choices that didn't contemplate the multiplying by the 2 pounds. You may see some questions that they'll give you, some where you're not, you're getting the right answer when you just do the units, but if you don't multiply by the, number of pounds or whatever it is you need per unit, you won't be able to get the right answer. Question? Okay. Okay, good. Let's take a look at this Trist company, and we're trying to figure out our direct labor budget. Okay, and they sit there and they tell me that they're supposed to produce, what month are they asking me for? September, okay, and so they tell me that in September the budgeted production is this what 14,000 units. Am I picking up the right number here? Okay, so it's 14,000 units, and so I'm going to pick up that 14,000, and it's supposed to take how much per item? Huh? Where's the 7 coming from? Why am I hearing 1.67, or am I hearing things? Am I hearing things, or did somebody say 1.67? I'm hearing things? Okay, so that's the answer I'm looking for if I'm hearing things. So it's 14,000 times what? 1.6? So what's that? 22,000 what? 22,400. Okay, good. And I'm supposed to pay them how much per hour? $15 per hour? Does that give me the answer? 336,000? Okay. Okay, good. Let's try this one. And this one now wants the what? Cash disbursements for my overhead, right? Now notice they're asking me what? Cash disbursement. So I'm going to have to be careful when they tell me about this depreciation, right? Okay. So what happens? I'm sitting here and I have 7,100 direct labor hours, and they're using direct labor hours as how they apply their overhead. So 7,100, okay, direct labor hours times how much per? Variable is $1.80. 7,100 times $1.80 is 12,780. Okay, good. And then what about, that's the variable, but what about the fixed? Fixed is 102,950. Good, but what? Good, less the depreciation of 19,880. Good job, Omar. Okay, take that off, and so that gives me now what? 95,850. Okay. So the only trick in those questions, I mean, they're pretty easy. Just multiply the variable times the number of units, and then add in the fix. But you always have to make that last end adjustment for whatever the depreciation is, right? Okay, good. Let's take a look at this one. Similar thing here, right? Okay. So variable selling, and they do it for, since it's selling and administrative, usually it's by the number of units, right? So it's the 6,600 units. Variable selling administrative is what, 970? Okay, so 6,600 times 970 is 64,000 something. 020. Then what do I do? Bring in the fixed. Fixed selling and administrative is 127,000. 380. Then what do I do? Back out the depreciation because that's not cash, right? 8,580 for depreciation comes out, and that should give me this 182,820. Oops. Circle it, not strike it out, right? Okay? Okay, good. Now, when they start getting into these questions where they want us to figure out what the cash balance is or how much they need to borrow, that kind of stuff, okay, what I do is I sit there and I always sort of just put off to the side, okay, I know they want to end up with how much cash? 20,000. So I stick that off to the side, and then I'm just going to compare whatever the cash balance is, and then that's going to allow me to determine what I need to borrow, whatever, right? Okay, so I kind of stick that off there just so that you don't run into confusion. You start to try to plug it in to the calculation, and to me that's when a lot of students make mistakes because they're trying to shove that into a calculation somewhere. I just put that, that's what I got to have, and if I don't have that, I'm going to have to borrow. If I have that much left or more, I'm not going to borrow anything, and the answer is going to be 0 to the question, right? Okay, but let's just go ahead and let's take a look at this one. And they have cash receipts of what? 125,000. They have disbursements of 138. Oops, and I forgot to include that they started with a balance of what? 17,000. I should have put that on top. That's the way I like. I guess I could have done it at the end, but I like to start with. Okay, I started with 17. I added 125, but I used up what? 138, so that's going to give me a difference of how much? Is it 4,000? Okay. And I'm going to end up with 4, but I want to have what? I want to have 20, so I guess I better borrow what? 16, right? Question on any of those budgeting ones? Operating budget? Remind me on too that for the mock midterms to put some questions that are the word questions. I think that ends up being the culprit a lot of times when their grades aren't where we want them to be because we spend so much time crunching on the calculations and we get so good at these, and then all of a sudden they say, what does budgeting mean, or something, and we're like, huh? And nobody ever will ask you that again other than within the walls of a classroom, and we kind of lose ourselves in that stuff. So remind me to put some of those on there. I think we do. I think we put too many of those questions. We should put maybe 1 on the exam or something. Maybe cut down on the number of questions and put 1 or 2 definitionals. But they want to give you 40 questions, and to give you the time to work it, they got to put a bunch of those dumb definitional questions that get us nowhere in life. Anyway.
Are those on the CPA exam, the definition questions?
They do have some on the CPA exam. It used to be that the CPA exam had an entire section of the exam that was theory, and that's all it was questions like that. In that theory section of the exam, it was just no numbers on the theory section. It was all just questions that were sort of that nature. But I seem to feel like for the CPA exam, when they ask you a question that's, definition or whatever, it's a solid question. I feel like a lot of these are kind of, what are they even talking about? I read some of these, I read these and I'm like, who talks like this? Whereas the CPA exam is going to be much more, much more not straightforward because it's not straightforward. Um, the CPA exam tries to make questions tricky, but again, how can I say it? I can teach you how to understand that question and answer that question. Whereas for some of those, I look at this, I'm like, I have no means as to how to tell you how to attack this question. So anyway, I don't know. CPA exam, the auditing exam is entirely There's no calculations on the auditing portion of the exam. And so you got to know your stuff. You got to know that when I am obtaining understanding of the internal controls, I'm not testing operating effectiveness of the internal controls. So which of the following would the auditor not do while obtaining an understanding of the internal control? Answer, testing of operating effectiveness. Huh? For the auditing, yeah, auditing is more questions of those nature, and so we study to understand the language that we use in auditing, and that's a little more precise because I need to be able to communicate to my staff, okay, now we're in this phase and we're testing operating effectiveness, and people actually do talk to each other about the nature of the work we're doing there, whereas in some of these other things that we're seeing in here, nobody talks about things in that manner. So yeah, it does vary by the section. Okay. Anyway, are you going to take the CPA exam? Why would you not? Okay. It's a very passable exam. Okay, so let's go ahead and let's take a look at this Project X, Project Y, and what do we do? Cut some of this off here. Both projects will have a useful life of 5 years. At the end of 5 years, the working capital will be released elsewhere. Sawyer's discount rate is 12%. And so we got a couple projects, and they want the net present value of project X. Okay, so net present value of project X, we're going to have to do what? We're going to spend $80,000 on equipment, aren't we? And so when we spend that $80,000 on equipment, when are we going to have to spend that? In the future or now? Now. So do we have to get a present value for that? Do we have to get a present value for that? So since that 80,000 is going out now, I'm just going to pick up the 80,000. That's my initial cash outflow, isn't it? Okay. Okay, good. Then what happens? Then they tell me that there will be an operating cash inflow of what? This $23,000? Okay, but that's in the future, isn't it? This 23,000. So if I take this 23,000, I have to multiply it times the factor for 5 years at 12%. Now, as I said, on the exam, they'll probably give you, they would give you, you don't have to memorize. On the exam, you have to memorize the tables. You know that, right? I'm just messing with you. Okay, you have to memorize this. Okay, just kidding. Okay, so what happens? So we'll give you either the portion of the table or the whole table. I'll have to look at those questions and understand how we're going to do that. I think they give you a portion of the table on these. But what's my interest rate? 12%. And how many periods was it? I guess I don't have the pen set up for this one. How many periods? 5. So it's what? 0.360478. Okay, so just going 12%, right? For what? For the 5 periods. Can you see it now? Okay. All right. So let's just make this 3.605. Okay, because we start getting into rounding, and I don't want to, get you scared that rounding's a big deal because it's not. So it's what 3.605 is what I'm looking for here now as my factor. 3.605, you say? Okay, and so I go ahead and I multiply that, and that gives me this 64,890. No, 82,915, right? Did I do my multiplication right here? How much is it? 82,915. That's an inflow, isn't it? Okay. And then what? Then I'm going to sit there and I'm going to get my salvage value on this project X, right? At the end of the project. Is that going to come back to me at the end of this? Hello? I'm going to sell this thing for $6,000 at the end, right? So I have to multiply that, and when I do, I come back to my tables, but I don't use the present value of the annuity table here, because this is not an annuity. This is a one-time payment, isn't it? So I have to come back to my present value of a single payment of $1. And if you ever get confused, you're not sure which numbers you should be picking up, remember, guys, all the numbers on the present value of the dollar table are less than 1, aren't they? Okay, so we're 5 periods, and what's my interest rate? 12%, so it's this 0.56743. Okay, I'm just going to make it 0.567. I just went down the 5 years over to the 12%, right? Everybody see how I got that number? Okay, so I just come over. I'm going to multiply it times, and I'm just going to go ahead and round it to 0.567. And when I do, that gives me the present value of this salvage value, right? Which is 3,402. Okay, good. So I've got 80,000 coming out initially, and then I've got this 82,915 coming in from the cash operating inflow, and then I got the salvage value coming back in 5 years. So that gives me a net present value here of a positive 6,317. Okay. Would you do this project? Yeah. What is it they say in Fremont? I would hella do that, right? No? Okay. Because it's what? Because it's more than what? Because it's more than that phrase started in Hayward, and it's worked its way over to Fremont over the years. Okay. Okay, so that's 6,317, right? Okay, good. All right, how about net present value now of project Y? Net present value of project Y. Okay. Yeah, project Y, do it. Well, we'll do it if it has a net present. Don't get me started on puns. You'll be sick of it. So I'm going to go ahead and I'm going to do project Y up here so we can just grab the numbers off of the right off the table here. So that was project X. So now we're going to do project Y over here. Okay. And so what happens? Now, we have this working capital requirement of 80,000. And, you know, the way I would look at a working capital, in fact, actually, this problem is pretty good in that it didn't give me a salvage value. So it could very well be that maybe I'm leasing this property or something, and the guy says, hey, you got to cough me up 80,000 bucks as a deposit because I'm not going to let you keep my super collider here, you know, after the time we're done. I'm just making up whatever this thing is. I'm not going to let you keep it, and I need a deposit so that you don't tear the thing up. So we're going to have a what? An initial tie-up of working capital cash that we're going to have to give the guy right up front to hang on to his piece of equipment, whatever it is, right? This $80,000. So that's going to go out now or later, that 80,000. That 80,000 goes out now. So when you see a working capital requirement, you assume that that's going to come out now, right? 80,000, okay? And then we're going to get in the future what? These cash flows of, what is it, 18,000? Okay, so it's going to be 18,000 for 5 years at 12%. So we should be able to use that same factor, right? I don't have to go back to the table, do I? Or do you want me to go back to the table to practice with it again? Who wants the table? Okay. All right, so we're going to go ahead and multiply 3, that times 3.605, the same factor. Okay, good. So 18,000 times 3.605 is going to be 64,890. Huh? Say again? No. The present value of an annuity table builds that in. That it's building in the number of payments. Okay, that's why all the numbers are more than one. So no, you don't have to multiply that times 5. It assumes if we're on the annuity table, it's adjusting right there for the number of payments. So that gives me 64,890, right? And that's going to be the 80,000's coming out, the 64,890 is coming in, right? Okay. Okay, good. Then what? This 80,000, guys, once we give him the equipment back, the guy's going to hand me the 80,000 back, right? I mean, he just doesn't get to keep that money, does he? He's got to hand me back that 80,000 at the end, right? Think of that 80,000, like I said, as a deposit that the guy said, hey, when you're done, you got to give me 80,000 if you want my equipment, whatever. We're probably leasing it, so he's going to make me give him 80,000 to take his equipment away. And then what? Then when I bring the equipment back, once I'm done with this project, he gives me the $80,000 back, doesn't he? Well, why not? I didn't buy it from him. Huh? Well, we have annual cash operating inflows. I'm assuming those are net inflows, so there might have actually been a rent. I mean, the problem didn't tell me all that. So we probably rented it from him, and he just made me give him a deposit just so we don't tear the thing to junk, right? And hand him back a piece of junk, and then he'll give me, and we're going to assume 80,000 back at the end, right? Okay. It's sort of like we're sort of, in a way, guaranteeing a residual value to him. If we're doing this for financial accounting purposes, however, we would assume the rule of conservatism that we wouldn't get anything back, that we would actually tear the thing up, and he would get to keep the 80,000. But for determining if we're going to do this project or not, we go ahead and we assume that we're going to get that 80,000 back, and we're going to take care of the equipment. He's going to inspect it. He's going to go, okay, it's fine. Here, I can give you the deposit back. I don't know. I'm making this up here, that there was even a deposit. You know, the point of this question is that if we have working capital that's tied up at the beginning, that working capital is considered released at the end of the project. Okay, so that's correct. That's the takeaway from this example. If you got working capital tied up at the beginning, that working capital gets released at the end. Okay, and I'm just making up this deposit scenario as a tie-up of working capital. Okay, so what happens? If that's the case, we're going to get that back, and is it going to be several payments like that or one? Just one payment, so I have to go to the present value of the dollars, just sort of like the salvage value coming back, isn't it? So I go back to that same table, and remember it was what? It was 0.567. Do I have to go back to the table to show you how I got that again? No? Right, there's just a one-time payment that comes back, 0.567. So the present value of that is going to be 45,360. And so 80,000, 64,000, then the 45,360 comes back. That gives me a present value of a net present value of a positive 30,250. Is that the answer? Okay, good. If you had to choose between Project Y and Project X, which one are you doing? I'm doing Y because it has the bigger net present value, right? So not only can I use this to screen an individual project, I could use it to rank the projects, and I would rank them in descending order in terms of their net present value. The higher the higher the net present, the bigger the net present value, the higher it is on the list. Companies will do this if they sitting there and they say, hey, we have limited resources to invest in these projects, so let's see as we go along the year if we have more capital available to invest in something, we will, right? Okay. Okay, good. Come over and let's take a look at the big payback. Okay, the big payback method. I'm going to call this the James Brown method of making decisions. You guys don't know. Never mind. James Brown has a song. You guys know who James Brown is, right? You don't know who James Brown is? Okay. You don't have soul music. You don't have rap music without James Brown. Okay. So James Brown was rapping before any of your current rappers were born. Okay. All right. So. Okay. So anyway, and he's got a song called "The Big Payback." And anyway, so let's go ahead and take a look at the payback method, okay? And so you come over, and remember with payback method now, we don't consider the time value of money, right? We just want to see how long it's going to take us to recoup our investment. So we sit here, and we have this 150,000 is the investment, and we have annual cash inflow of how much? 40,000. So we simply divide that 150,000 by the 40,000, and that means it's going to take us what? 3.75 years to get our investment back? Very, very, very crude method. I mean, almost no business decision is made this way. The only decision I've ever seen talked about in this way is refinancing your house. You figure out what the closing charges are going to be, the loan costs and stuff are going to be to refinance your house, and you divide that by your savings and your payment, and then that tells you how long it'll take you to recoup your the cost of the loan. And they say, they use as a rule of thumb that if it takes you more than, I think it's something like 2 years or something, they say don't do the refinance, I guess. It's something like that I've seen. But even that is stupid to me. But that's the only thing I've ever seen given any kind of legitimacy for this kind of method. Okay, we typically want to do what? We typically want to do the net present value method. Okay, for this. And so let's go ahead and let's take a look at net present value. And notice, guys, we can use the same exact facts for different methods, right? Okay, so now we have 150,000, and the 150,000 is going to go out when? Now, so that's going to be a subtract now, 150,000. And then in the future, we're going to have to spend what, $40,000? Is that what it was? Not spend, but what? Cash inflows of 40,000 in the future. So that 40,000 in the future, but to turn it into dollars now, we have to get present value, don't we? Okay, so we go over and we see that it is a 10-year project, and the required rate of return is what? 10%. So let's just go ahead, let's practice with the table, finding a new factor here. So we're coming to present value of a dollar. Is this the table I should use? I need what? Present value of annuity. Good. The interest rate was 10%. There's my 10% interest rate right there. And And I want to find how many periods? 10. So I've got 6.14457, whatever. So I'm going to just use 6.145 if you don't mind. Okay. So 6.145 times the 14,000 gives me what? 245,800. Okay, so that's going to come in on this. So this project has a net present value of what? 95,800? Right there? Okay. Okay, good. Now, let's take a look at the internal rate of return. Now, the way we do the internal rate of return is we have to sit here and we basically have to use this table backwards, don't we? Okay, so we know that we have to cough up 150,000 on this project. We know that it's going to do what? Well, let me set this up a little bit better. 150,000 is going to have to be equal to what? To a present value factor times this 40,000 a year, isn't it? In other words, we want the net present value to be 0, don't we, for our internal rate of return? This will set my net present value to 0 if the present value of these payments equal what I'm going to spend today, 150,000, which is already set at present value, right? $150,000, I'm spending that when? I'm spending that now, right? And I'm saying that the 40,000 times what? Times some factor will give me a present value of 150,000. That makes the net present value 0. That is by definition my internal rate of return, right? A factor that equals 150,000 will make those 40,000s equal to 150,000. That means my net present value will be 0 here, right? Right? Okay, so I set it up like that, 150,000 times some present value factor got to equal, 40,000 times some present value factors got to equal 150,000. That will make my net present value 0, right? Right? So I go ahead and I take 150,000 divided by 40,000. So just doing the algebra, that factor's got to be what? 3.75, doesn't it? So I know the factor. So now I go back to the table and I find the present value of an annuity. That 40,000 is annuity. How many years? 10 years on this. And I just start going down the table and I don't find it on this table. So I have to go to another table. And I won't find it here, I promise you. And this is where the tables start driving me nuts. I mean, who decides what percentages should be on these tables? I don't know. So I have to always look for a table that gives me what I want. I guess that's how life is, right? Okay. So how many periods? 10. And I come down. Do you see 3.75 yet? I don't see it. Where is it? I keep coming down. I don't see it. Come on now, 3.75. Where are you? And I get this 3.799, and then I get this 3.682, don't I? So this number, this internal rate of return, is somewhere between 23 and 24, isn't it? If 3.75 is a factor. It's somewhere in between those two stupid numbers, isn't it? Okay? And so what happens? I come back and I look at the question, and when I do get 24% sitting there. So now I'm like, okay, how am I supposed to know if it's 23 or 24 because it's somewhere in between, isn't it? Okay. Now look, you're not going to have to do this on your exam, but I'm just going to show you what this question contemplated because I don't think there's any that get into this level of detail on the exam. But I just want to show you what happens when you get in between. You got to figure out which one it's closer to. Okay, so what happens? Well, if I'm looking for 3.75, okay, so I'm going to take what? The factor, I got to get back to the table now. The factor here at 23, the factor here at 23% was what? $10, 23% was 3. What did I say I was in between? I'm in between 22 and 23, right? On the bottom of what? 3.799? Right there? Okay, so at 23%, it's 3.799. Let me see if I can make that a little bigger without screwing this whole thing up. 3.799 at 23%. Okay, so what I'm going to do is I'm going to go ahead and I'm going to put 3.799 minus what? 3.75 gives me, number please, 0.049. Okay, good. And then the other factor, which was at 23%, right? Because it was in between those two numbers, 3.799. 3.799 and 3.682, right? Is the two numbers I was in between there? Right? So 3.682 now, going back to my calculations here, which have now decided to what? Disappear on me? Where'd my calculation go? There it is. Where was it now, Omar? 3 point what? 3.682. But let me just put the 3.75 I'm going to put first here just so I don't start getting negative numbers to make it confusing. Versus what? 3.6 what? 682 gives me a difference of what? 0.068. Okay, so I'm actually what? I am actually closer to the 23%, right? If you look at the difference between the two. So at that point, you could determine that the factor that I'm closer to is 23. And I guess they didn't even give me 22, did they? So I am definitely closer to what? 23%. And I guess theoretically, I didn't even have to do this because they didn't give me what? 22%, which was the, 24% was the next number. So I did have to do that, right, to determine that it wasn't 24 and it was 23%, right? Now, if I wanted to get the number precisely, if I wanted to sit here and say, well, where am I, exactly what is the rate of return on this? I could do something like this. I could go ahead and say, okay, 23%, and of course it's going to keep you-know-whatting with me and disappearing on me here halfway through my discussion. Damn thing. Okay, so what happens? My 22%, come on, number. Don't say it, John. What you think? What word do you want to use for these numbers? 3.7. They want to disappear. 3.799. Maybe I can write it here. 3.799 is the 23%. And what? And the other one is 3.682. So that gives me a total difference between these two numbers of point. What? I got 0.117. Okay, the difference between these two numbers is 0.117, right? Okay. Meanwhile, what? The difference between 3.799 and 3.75, we already calculated to be what? 0.049? Right? That's the difference between 3.799 minus what we calculated the factor to be, 3.75. So that gives me 0.049 as the difference, right? Right? Okay. And so what happens? If you go ahead and you divide 0.049 by 0.117, that gives me a number of approximately here, what? 0.41883. So that means that 0.049 has accounted for about, what is it, 0.41? For about 42% of the difference between 23% and what? 24%, right? Right? Which is a 1% difference. So if I take that 0.41 and I multiply that times 1%, that means that I'm dealing with what? I'm sitting here and I'm dealing with 0.00418%. Okay, and I mean not point or not percent, but 0.004188. And if I'm already at what? 23%, 0.23, because I'm what? I was already at 23 and I'm heading towards 24. That means that the actual interest rate on this thing, or rate of return, I should say, on this thing is what? 0.234188, right? Just using this table. Okay, because I accounted for what? 41% of the 1%. I take what? 41% of 1%. I get that number and add it on to the 23% that I'm already there. This gives me more precise. If I had to come up with a more precise internal rate of return, I could do it this way, right? Okay, that's beyond what I'm going to ask you for the exam, but since we didn't come, because I think in the exam it's sort of the what I call the Dora the Explorer approach, in that you always get exactly the right number, right? Good job, you know. Meanwhile, what? Meanwhile, in reality, you're going to always get numbers that are sort of in between. Okay, nothing works out perfectly like this. So what I just showed you is a process of interpolation. is what they call this, in which you would sit here, figure out the distance between the number you're able to find on the table and the number you were looking for. That gives me the difference. And then what? Then I sit there and I see what percentage that attributes to the total difference between the two percentages. In this case, the 23 and the 24. That gives me what percentage of the difference is accounted for here by my number. And then I go ahead and I do what? I multiply that by 1%. That gives me now in a percent what the difference is, and I add that to the 0.23, not 23, but 0.23 because it's 23%. But I add that to the 0.23, and that gives me more accurate interest rate there. 0.418834, Omar, is the 0.049, which was the difference between the number I was looking for and the number I wanted, divided by 0.117, which was the difference between the 23% factor and the 24% factor. Because I'm trying to figure out what percentage does the difference between what the number I was looking for and the first number I get, what percentage is accounted for by the number I was looking for, and then I can just go ahead and then turn that into a percent. Turn it into 1%. Oh, it's a percent of a percent, and then that goes ahead and I can add that to the 0.23. This is called interpolation. Okay. Okay, but this is a stupid problem. I don't know why I put this on here. Because most of the questions, I mean, it allows us to have this sort of nerdy discussion here about interpolation. But I don't know that it prepares you any better for your exam. Where'd it go? Now what? The whole problem disappeared? Huh? Oh, okay. Yeah. Okay. Okay. All right. Let's look at this one. The payback period on this thing is how long? Well, this one you have to be a little bit careful in that what? I mean, not this one, the next one. This one, to get the payback period, you're just going to, payback is easy, right? It's simply the $240,000, the initial investment, and I divide that by what? Divide that by the $50,000 annual cash flows that are going to come from that. This investment's going to pay me back in how many years? 2.8? 4.8? Okay. Do you want payback method questions on your exam? Okay. I mean, just a piece of cake, right? Huh? I don't have that power. But I wouldn't do that anyway. Okay. Now, the net present value method, though, guys, is not much more difficult. How much am I going to spend now? 240. How much am I going to get in the future? 50,000, and it's going to be 50,000. Do I need to go to the table? I do? Okay. Do you want me to, I mean? Okay, so I'm going to go to what? I'm going to go to required rate of return is 10% here, right? For how many years? 8 years. Okay, so I go back to the table. Let me go back. I like this table up here better because I'm more used to it. Present value of an annuity, right? And I go, and it's how many periods? 8 years, and the interest rate is 10, 8, 10, 5.33493. Okay, so I'm just going to make it 5.335 if you don't mind. Okay. So it's times 5.335 3, 3, 5 is the factor. That gives me what? 266,750, you say, Jarn? So that's the inflow, right? Okay, and so when I do this, I get what? 26,750? Okay, so hey, yeah, payback's easier, but net present value isn't exactly going to kill us, right? In terms of calculations. Round what up? This one? There will never be an answer in which you have to decide between two choices due to a rounding question. Okay, so, but I'm pretty sure most of the questions on the exam, they fix it so that you don't have to worry about rounding at all. Okay, but there's never like, gee, if I round, I get this. If I don't round, I mean, look at these other choices. I mean, there's no way that a rounding is going to cause one of these other choices to potentially be the right answer, right? Okay. Okay, good. Now this one is, I don't know if it's something that we had mentioned before in the lecture, so this is actually a good question for you to learn something from. Okay. So let's just take a look at this one. And they give me the net operating income, don't they? Okay, they want payback. And you're thinking, okay, great, I love the payback method. But notice they just give me what? Net income, don't they? But if I'm figuring out payback, I have to figure out how long it's going to take me to recoup my investment. I need cash flows, don't I? So the cash flows on here is not 5,000. The cash flow is what? 7,000, isn't it? I have no idea how this is going to turn out since the pen is deciding to be an idiot here. So that's going to be 7,000. Okay. And so what happens? Now to figure out the payback period, I've got to pick up, what was my initial amount of my investment? 20,000. Now I've got to take the 20,000 and divide it by 7,000. And that should give me the 2.9 years. Right? Okay. So when you're figuring out payback, guys, it has to be done on what? I think it comes out to 2.857 or something stupid like that, but clearly 2.9 years. Okay. So when I'm doing the payback method, if I give you a problem which I call out some amount of depreciation, now be careful because if the question gives you the cash flows anyway and the depreciation, then you would have to know to do what? Ignore the depreciation number, right? But if I give you operating income, then you're going to have to add back depreciation to get to the cash, right? Right? Question? Okay, so let me make sure I've got this straight. Wednesday, no class, right? Right? Okay, Wednesday we will not meet. A little bit of vacation holiday bonus for you for working so hard and having us to where we're really ahead of the curve here, right? Okay. Then what? Monday, after the holiday, we're going to take a comprehensive look at all questions that could potentially be on the midterm, right? On the final. And then on Wednesday next week, we will come in and actually do a mock final where you're going to have to sit down and I don't know that you need to bring the Scantrons, by the way, because you should be able to, yeah, bring them so I can run them. That way we don't have, I was going to say we could just sit here and go through each question at that point, but we do it that way you don't get the full amount of time to work the questions. Instead, we're just going to have to save some time to go through them together. So instead, oh, wait. Let me think again. You could just take that test with you, right? Rather than mark it on the Scantron, mark the answer on the test itself and just take it with you. And then come back with that document on what? Now it'll be Monday at that point, and we can go through it together at that point. That way you don't waste a Scantron. You can just see how you did after you go through it, right? And look, there's no benefit. Don't take it home and look it up and change the answers because you're not going to get an accurate read of how you did on the test that way, right? So just leave it alone. Come back. We'll correct it on that Monday together. And then I don't know what we'll do after that. Maybe we'll do that again. Wash, rinse, repeat, huh? Yeah, bring some pie. So bring some turkey with you. Okay? Huh? Depends on how good the turkey is. Okay. Okay, guys, look, have a good Thanksgiving. Try to get a little rest. Make sure to spend some time with your family. And I will see you. Thank you, sir. And make sure you signed in. And I will see you on a week from today, okay? And we'll do that comprehensive final.